Hello, this is Vlad, and here we are with another trade review. This time trading through the launch macro. Okay. But before we deep dive into the trade itself, let me just do a quick review of the morning session. Here is 9:30. Here is 9:30, and we had an initial drop down before going up. Now, the opening range gap at this day, I'll now plot it on the chart, was a discount gap. So we're expecting within the first 30 minutes between 9:30 and 10 o'clock for price to go to the mid gap. Okay, so here is the mid gap. So we expect that to happen. As Michael says, there is 70% chance of this happening within the first 30 minutes of trading. And this is backed by 40 years of data. So we can definitely trust this. But overall, even though we were opening with a discount gap, my initial bias for the morning session was bearish. And why is that? Well, because we were already trading very, very close to this major pool of sell side liquidity, laying at 20,114. And if you allow me to jump on the 4-hour chart, I'll show you what is that level. So, is that level here? October 1st, 2024, and this is a month low, okay, for NQ. We all also have relative equal lows, and we are trading very close to it. So I was expecting that this pool of liquidity will be attacked in the morning session. And because it's a month low, it's a point of interest for us where we can hunt for reversal or retracement patterns, or maybe try to catch a continuation pattern. If price wants to move further down, in this case it didn't. It actually started reversing for the day, and I capitalized on this using the launch macro. So going back to the 1-minute chart, going back to the 1 minute, here it is. And I do apologize, here is my 1 minute. Okay, going back to the 1-minute chart, there was a very good setup in the morning from here, from the opening range gap all the way down to the sell side liquidity. I missed that setup. I was not on the chart, but then I saw it after that. The move was already around here, around 10 o'clock. And I saw it, but I didn't want to chase it at this point. It was way too close to the sell side liquidity for me to try to chase it. But what is Michael always telling us? One thing that people really struggle with, how to identify the right fair value gaps. If you're trading the 2022 model, I'm 100% sure you're struggling with this unless you are a very, very experienced trader and you already fix your shit together and you can identify these things. But most people who are trying to trade the fair value gaps, they struggle to pick the right ones. Well, using the morning session, your 2022 model fair value gap will form around the opening range gap. So when you want to see price leaving the opening range gap, with a fair value gap, okay? So we already established that we had an initial bearish bias for the October's lows, and we want to see price leaving the opening range gap by leaving fair value gaps on the way. Now, why? The first question you're going to say, yeah, but there was a fair value gap here, right? And let's make it bearish because the bias is bearish. So I'll make it red. Why this fair value gap didn't hold? Well, remember guys, it's time and price. If it's not the right time, price is not going to move. So this fair value gap, when did it form? What time is it? 9:42. At 9:42, it's a little bit too early for price to start displacing lower, okay? Especially after we are working that opening range gap here, okay? This is why you don't trust this gap. You just watch what price is doing around this gap. What is price doing? Trades right through it, totally disrespects it, goes back to the opening range gap. This is not what you want to see. If the market is heavy and it wants to move down, you don't want to see that. This fair value gap being disrespected and then price going all the way back into the opening range gap. See here, it went all the way back to the midpoint of the opening range gap with a wick only, okay? There was another thing that was supporting our bearish idea, and it was the fact that we left the upper portion of the opening range gap unfilled, which was hinting at heaviness for the morning session. But then, what happened here? What else happened after that? After we totally disrespected this gap. So let me remove it. Price goes back to midpoint of the opening range gap. Then it starts going down again. What is it doing here? It's leaving a fair value gap on the way out of the opening range gap. So it's displacing away from the opening range gap. This here, and then there is another fair value gap here forming right after it. So it's two fair value gaps. This is an indication that there is institutional sponsorship behind this move starting to happen. This is what the displacement means. You also have this down close candle here, which is a breaker in this case. So that will be your breaker. And I know it doesn't look like one because there is no intermediate low, but if you go on a lower time frame, sub 1 minute time frame, this will be a low and a breaker here. Okay. Let me mark this as a breaker. Like this. See where price is stopping? Yeah, exactly. Now, if you're a 2022 model trader, this and these fair value gaps, these are the ones you want to trade. Now, we already established that we have a draw on liquidity, which was October low. We already established that we are displacing out of the opening range gap. But what's the difference here? What's the difference compared to the previous gap? The difference is when this gap formed. Look at the time. The time is 9:50. So from 9:50 to 10:10, there is a macro. A macro is starting. So this is probably the missing key why you cannot figure out the correct fair value gap. So we established that we have a fair value gap here and a fair value gap here. Now, from the 2022 mentorship, we know that whenever we have whenever you have two fair value gaps right next to each other, you want to be trading the first one, but you have to allow for your stop to cover the second one, because price may wick through the first one and reach into the second one. Look where it stops, right at the midpoint of the upper fair value gap. Okay, so if you want to trade this aggressively, your stop should be above this midpoint. Or if you want to be a little bit more conservative, it can be above the fair value gap. Or if you want to be really conservative, it can be above this candle's high. The candle that forms the gap, the candle that displaces away from the opening range gap, your stop loss can be above this one. Okay. So why is this valid setup? First of all, it's a macro. Second of all, we have a clear draw on liquidity down. Third of all, we left the upper portion of the opening range gap open. Okay. We have a breaker. And finally, we respect the 2022 model rules, where this candle here wicks through the first fair value gap into the second one and stops right at the midpoint. This is algorithmic price delivery, and whenever you see this, it means the algo is working and it's going to start using that macro window to spool price down, okay, towards our draw on liquidity. So this here would have been something like this. Let's say if we enter on this candle at 952 with a stop loss, let's say it's very, very conservative above the displacement candle high, this would have been the setup, targeting the drawn liquidity, which was the October low. See, that's a 3R, easy, quick and easy move, okay? Almost no drawdown, no heat against you, okay? Absolutely perfect algorithmic price delivery. Okay, I wasn't on the charts to see this setup, but it was so textbook. Okay, and let me know, guys, if you want me to break such trades down for the future. They are quite powerful. Also, there was another thing that I forgot to show you. Whenever you trade the opening range gap, you also want to include your first presented fair value gap, as Michael advises. Here it is with this purple box, and I'll remove for now the opening range gap so the chart is a little bit less busy. See what we have here. We started working this first fair value gap up and down initially, and then here once again we displace away from it. First of all, we close below it, and then the next candle displaces away from it, leaving a fair value gap. This first fair value gap that you see, that is exactly what you want to see, okay? Then price goes up. This upper fair value gap just so happens to overlap with the first presented fair value gap. Look at their midpoints. It's almost perfectly matching, okay? They're almost perfectly matching. It's one probably thick difference between them, okay? One thick difference between these midpoints. And then price goes down, okay? Now, enough with this. Moving to the trade that I actually took during the launch macro. And what was the idea behind it? Now, after we took October's low, we want to be watching how price behaves around this level, okay? Around this level, price didn't really aggressively go through the October lows. It actually stopped here and started accumulating right below the October lows. That's a signature in price action telling you that the market is accumulating. Smart money are accumulating and they are not willing to send price further down, at least not for now. So price then reacts, goes back into the range, starts accumulating here, going up and down. See how it reacts around the October low here and here. So all this price action, all this accumulation here, we don't see any displacement below this sell side liquidity. Do you see any fair value gaps displacing down from this sell side liquidity from the October lows? No. And then what happens? We have this 11.29. Once again, think about time. Always think about time, guys. If you want your PDA rates to work, you have to pay attention to time. There is no other way. If you don't want to pay attention to time, ICT trading is not for you. Okay, it's not gonna work if you don't pay attention to time. Period. Period. I know people are saying this fair value gap doesn't work. Other fair value gap doesn't work. Yeah, because you don't pay attention to fucking time. And that's the simple reality. Okay? I can bet my ass that people who consistently complain about PD arrays not working, they don't pay attention to time. They don't include time as part of their trade idea. Okay? If you do that and you work on it long enough, backtest it, you will see that time is the single most important element when your PD arrays should start forming. Of course, they should also form at a point of interest. So there is also this element of place where on the chart you can expect time and price to start acting in your favor. And there is very simple, very simple things to look for in order to identify where on the charts it should happen. Okay. Anyway, one of these things is previous months highs and lows, previous weeks highs and lows, previous days highs and lows. Okay, previous sessions highs and lows. Depends how further down you wanna break into. Okay, so what is the time frame that you're trading? What kind of trader you are? But anyway, we established that we have a point of interest here. 11.29. One more tap into October lows, and then what happens? What is that? It's a displacement. When is it forming? When is this BC forming? Here. This BC is forming at 11:30. Okay, from ICT we know, and I mentioned this in previous videos, that 11:30 is when the launch macro starts. Okay, the launch macro, it's not from 12 to 1. Forget about it. The launch macro starts from 11:30 to 1:30. Okay, sometimes the move can start at 12, but the launch macro starts at 11:30. Now, what is the purpose of the launch macro? What is the algorithm looking for during the launch macro? It looks for the liquidity that all these people who are making money in the morning generated. Okay, whoever was making money in the morning, during the lunch macro, the algorithm will go against them. Okay, the sellers were making money in the morning. So during the lunch macro, what is the algorithm most likely to do? The probabilities are in our favor for the algorithm to go bullish against the people who were making money in the morning. So 11:30 we displace up. Then what happens? See that? One tick into the BC, that should be green by the way. One tick into the BC and then price starts going up, forming a order block. Okay, this order block is what I traded here and here. These are my entries. You do not want to see price go back into this BC. If it's strong, if the move is really good, you don't want price to go back into this one. Okay. This order block should hold. We have a breaker here also. The last up close candle, this move. See? Perfect. Absolutely perfect. And I want this on the bottom because it's gonna act as support. Make it a little bit smaller. So you have a breaker here. Price touches it into the BC. This is your unicorn model. Okay. This is your unicorn model. Displacement. Then what do we have here? Between these two bearish candles, let me make that bigger. Between these two bearish candles, we have a volume imbalance. Okay. And then we have a displacement up, leaving another BC. A BC that originates from a volume imbalance that's very powerful. Okay. It's a very powerful PD array that will shoot price up. If you are on the right side of the market, this should shoot price aggressively up. Okay, it's like a trampoline. Okay, it's the same like this one here. It's like a trampoline where price will go down, it will spike through the volume imbalance with the wicks, see how the bodies are respecting the BC, and then it starts going up. On the way up, it leaves another BC here, taps into it 1148, and then continues going up. On the way up, I'm offloading from my position. Why I'm offloading from my position? Because we are here within this huge displacement in this CB, and my final target was the low of the first presented fair value gap. Okay, I wanted to be done by noon. I had other issues to attend to. I didn't want to sit all day on the chart, and I wanted to be done with this single trade. However, I'm offloading here from my position because price started a little bit hesitating, and we were also approaching the 1150 to 1210 macro. Okay, we already took this high, this buy side liquidity here, which was the high formed between 10:30 and 11:30, an intermediate term high that the launch macro will target. Okay, whenever you're looking for launch macro trades, when the algorithm will go against the people who are making money in the morning, your pools of liquidity should form after 10 o'clock. That's what Michael advises. Okay, so this was the most obvious pool of liquidity that formed after 10 o'clock. It's right into the CB here. Okay, it's formed at 10:45. So this was the first logical target. Look at my exit here, right there. Okay. Then we go deeper into the CB, and I'm offloading more here and here. I left a single contract open where I wanted to allow for the algorithm to go back into the first presented fair value gap, and it happened here. Okay. This happens so often that I cannot explain to you. We have an initial move in one direction, in this case bearish, then the last macro starts going against the bears, taking the buy side liquidity, and then it goes in the direction of the first presented fair value gap. Now, do you remember that we opened at a discount today? Yeah, we did open at a discount. So what do you expect price to do when it's at a discount? It should start going up to a premium. So look at this. What happened during the PM session? Here, we worked the first presented fair value gap. Let me plot the opening range gap again. After we worked the first presented fair value gap, what happened here? At 108, we displaced away from it. We are displacing away from the first presented fair value gap. So now price goes back down. When is the PM macro starting? It's starting at 130. Okay? After we close the opening range gap, remember the opening range gap is at a discount. So we expect price to go further up. Yeah. What is the algorithm doing? Going back down. Look at this candle. What time is it? It's fucking 1:30. It's when the PM session starts. Not even touching consequent encroachment of the first presented fair value gap, goes one tick above it. And then what does it do once again? Here, displaces out of it with the fair value gap, displaces out of it with a second fair value gap. This here is the exact same logic as what happened during the morning session. You have two fair value gaps, so the first will be your entry. But you have to allow your stop to cover the second one. In this case, we don't wick to the second one. But when you enter here, you want your stop to cover the second one. If you are conservative, it's going to be here. If you're a little bit more aggressive, it's going to be here. And if you're very, very aggressive, it's going to be here. Okay? But let's say again, you're conservative. You're a new trader who is scared still, unsure what exactly is he doing, and you want to be conservative. That's fine. You don't want any too much heat going against you. That is fine. Apologies. I switched to ES for a second. So, back to it. Now, knowing all this, let me remove the opening range gap, which, by the way, you can expect now to be used as an inversion gap. Exactly, as an inversion gap. So we should trade above it and then start going up. But here, back to this entry. So this is your 2022 entry with a conservative stop loss and first major pool of liquidity here. Let me remove this one, it's some old. markup. So we have the first buy side here. This is the low hanging, easy objective. Easy, absolutely easy for almost 3 hours again. But if you actually take the fib, measure the range here, and add where is it? 0.25, is it? It's actually minus 0.25. No, where are you? It's 125. Why is it not showing? It's probably same color as this one. You make it green. No, it's minus 125. Okay. Oh God, it's like this. Okay, so this can be your target, even though you see that we reached even higher. But this can be your target. What is also here? What is this gray box here? This is the first presented fair value gap of the. Where are we? Apologies. This is the first presented fair value gap of yesterday. Oh my God, where am I? So, if you put the minus 0.25 as the next likely extension, you see we spike through it, and you see that this level coincides with yesterday's first presented fair value gap. It's logical that the algorithm will reach for that fair value gap. Okay, so you can also use that as a target. It's really flexible, and if you can trail your position properly, you can actually capitalize on an even bigger move. See, where you can project this range twice and reach for this as a target. Okay, like here. But let's say you're not so optimistic. You want to target the yesterday's first presented fair value gap. That's a 4 hour. Would you be disappointed with that? It's actually a massively good trade. Okay, with almost no heat here. So, guys, the PD arrays work, but they work with respect to time and with respect to certain points of interest on the chart. So, this is your job here as an ICT trader. You have to learn when the algorithm is likely to do what. Okay? And you can start here. If you're trading the morning session, you can start at this. In the morning session, you look at the opening range gap. There is a 70% likelihood that we are going to trade to the midpoint of that gap within the first 30 minutes of trading. Unless you have some high impact news at 10 o'clock, you can trade that range. Okay? You can absolutely do that. Or unless the opening range gap is very small. So if it's less than 20 handles or less than 40 even, that's a relatively small gap, and you can expect messy delivery within the first 30 minutes. Then you're gonna wait for your 950 to 1010 macro. Okay. So moving on, during the lunch hour, you want to look for whoever made money in the morning. You want to trade against them. Okay, that's what the algorithm wants to do. The lunch macro starts at 11:30 and ends at 1:30. So what you want to identify during if you're going to trade the lunch macro, that's a pool of liquidity that formed after 10 o'clock up until 11:30, and you want to use that as your drawn liquidity. Okay, and then same thing for the PM session. If it's a reversal, like in this case it was a reversal. See, by the way, where is the opening price? Where is 930? 930 here. This is 930. Let me make it bigger. Let me make it bigger and darker. Here, this is 930. What do we do after the launch macro? That's a, if you're using the open, high, low, and close concept and using 930 as the open, so you have an open, low, and then high and close. Okay, this is the market switching gears, is switching from sell program to buy program. Okay, as soon as we trade above 930, and also look at this here. Look. What happens? 1 o'clock. Isn't that displacement above the opening price? Isn't that displacement above the opening price? Isn't that displacement happening at 103 during a macro window? Yes, it is. This is also, we have a pool of liquidity here. We have the Indigo model that I mentioned a couple of videos ago, and I also left a link in the description back then where you can hear Michael explain it in the Indigo model, which is basically a volume imbalance within a pool of liquidity, where this second candle here, let me show you. This second candle here, here is the volume imbalance. This second candle trades within the first candle, okay, and forms the volume imbalance. And then we have a displacement. We have the order block with the displacement forming. Now, you can allow this candle to go all the way down to the volume imbalance. So you have to consider all this order block when you are trading this, okay? So anyway, more on the Indigo model maybe in the future. Michael actually explained it very, very well, so I advise you just go to his lecture and listen to it. The key point here is, as soon as we displace here above the 930 open, this is when we are going from a sell to a buy program on the daily chart, okay? So this is now bullish, and you look for these signatures here that we explained. 1:30 PM session starts. This is what you want to trade here within all this context that I just shared. So context, it's very important. So I gave you all the key levels. I gave you the times to look for. These are the things that will help you to make fucking sense of what Michael talks about. Make fucking sense of his PD arrays, and to finally see that they work. They work, but they work within a context. If it's not the right time, they're not going to work. Nothing will work when it's not the right time, okay? Nothing will work when it's not the right time. It's as simple as that. So, if you want to learn ICT, learn fucking time. That's how you start. And then learn the PD arrays. Learn to recognize them with respect to time. And then it's gonna click. Anyway, very, very busy video. It was going to be a trade review, but I actually deep dived into the whole price section of the day. And I gave you a few setups that you could take in order to bank some buck. And I guess this is enough for now. So until I speak to you next time, I am out of here.